At the start of the year, Lateline Business asked 5 leading economists where they thought the stock market, the Australian dollar, interest rates and unemployment would be at the end of the year. Well, at the end of Lateline Business's year, that arrives tomorrow, so we've checked back in with our experts to see how they fared. Andrew Robertson reports.
The stock market began 2010 at 4,900 as it continued its strong post-global financial crisis recovery, and there were no signs at that stage that it would stop.
The price to earnings multiple was well below historic norms, and that suggested that as investor confidence improves, the market could rise just for that reason alone. Secondly, I thought we'd see good earnings growth, and I thought, most importantly, that the global and Australian economic recoveries would continue.
The buoyant start deceived all our experts into making positive predictions for the year, with Shane Oliver the most optimistic. Only Westpac's Bill Evans and JP Morgan's Sally Auld expressed any caution. Their forecast of 5,000 was an increase of only 2%.
At the start of the year, Andrew, I was quite sceptical about the recovery in the US economy. Many people were talking about V-shaped recoveries at the time, and I was very sceptical that whilst there was V-shaped evidence at that time, it was to do with transitory factors such as government spending and the inventory cycle.
But it was events on the other side of the Atlantic Ocean which ruined all our experts' forecasts and sees the market limping towards 2011 at around 4,600, a loss of 6%.
It crashed really heavily in the wake of the Greek sovereign debt crisis. Now, that wiped about 15% by the time that crisis was over off the value of our index. And basically, it's been difficult for the stock market to recover that loss.
While the stock market